Hey guys, my name's Jose, and this is another episode of Buy or Pass. In this series, I will look at the financial documents of a company and decide if I was looking for another investment, would I buy or would I pass? Before we start, don't forget to hit the subscribe button to get info on new episodes and other videos. So let's begin. I'm going to use a website known as lazyfa.com, which allows me to see all these financial documents in an easy visual form. So let's begin. Today we're going to take a look at Papa John's. Like always, we're going to start off with the income statement, and today we're going to look again at the annual data opposed to quarterly data since they just reported Q4 on to end the year. So I prefer to look at the annual data to remove any noise. Let's start off with revenue, and first thing I can see here in revenue is we can see this huge decrease in revenue compared to last year. Last year was 1.78 billion. This year was 1.57 billion. So we see a decrease between last year. Cost of revenue makes sense, right? Their cost of revenue went down, but that's because they had a lot less revenue to charge for their cost of revenue. So their cost of revenue this year was 1.15 billion compared last year was 1.3 billion. And we can see the gross profit it's lower than 2017 and 2016. Right now we're sitting at about $421 million of gross profit, where last year was 487 and the year before that was 482. So it's definitely not looking like a good time for pizzerias right now. So here we can see earnings before income tax. It's pretty low compared to the previous years. I'm pretty sure we'll take a look at the expenses in a bit to see where this huge decline went down. Because last year they had $147.39 million of earnings before income taxes, and this year they barely have $30 million. So a huge decrease if we're looking at the chart here. It definitely dropped a nice amount. Remember, from 147 to $30 million. And we can see revenue itself was not that bad compared to those numbers. So we'll take a look at where this company has lost its money. So just to that, our net income this year was pretty much almost zero. It was 1.65 million compared to last year's 102 million dollars. That is a huge decrease, almost 99% decrease in net income. I wonder if they're starting to do different no, all right, so next let's try to look at where things went wrong. We're going to take a look at Lazy FA's red flag. All right, so now we're going to take a look at what went wrong. Here we're going to take a look at Lazy FA's red flags. We're going to take again a look at the income statement, and here we can see, right, just what we were mentioning before, revenue versus cost of revenue. We can see that gap between revenue and cost of revenue is decreasing, and that's why we have that gross profit decreasing, right? Our gross profit is the difference between the two. We can see here gross profit is decreasing as we get our revenue and cost of revenue closer. So what I'm looking here at revenue versus cost growth percentage wise, they seem to always go almost a 1-to-1 ratio if we take a look at most of the past years, and this year was no different. Cost of revenue went down by 11%. Revenue growth went down by 11.78%. So that's pretty similar to what we normally see. Here we can see what went wrong. Our gross margins is pretty much on par with how it normally is. We have about a 26.8% gross margin, where normally last year was 27.3 and the year before that was 28.1. So we're around the ballpark, but here we can see our profit margin is dramatically low. This year their profit margin was 0%. Last year's was 5.8, the previous year's 6. So we can see we're way below that margin. They barely collected any money, and that's why we saw that net income was pretty much zero. So let's take a look at some red flags Lazy FA is telling us about. The first one is just our simple that cost of revenue grows at a faster rate than revenue itself. We can see the big outliers here in 2014, 2012, and 2011, which might have caused this flag. But at the moment, this is not really something for me to really take a look at. Next, we have another red flag. Book value per share currently negative. So if we take a look at bar wise, it's been 2 year, this year and last year. This company has had a book value per share and the negative. In 2016, the end of 2016, it was negative, but almost pretty zero value. Now it's negative $10 per share. So for you guys that don't know, shareholder equity is the difference between our total assets and our total debts, and that's pretty much what the shareholder is paying for the company, right? So that what the company is worth after it pays off is total debt. So right now, its shareholder equity, will probably take a look at the balance sheet, is negative. So now once you have that shareholder equity, you divide that by the number of outstanding shares, and it gives you what the true value of the company is. So right now it's telling us the true value of this company is negative $9, negative $10. So essentially you're paying for a company that's negative $10 in debt. So it's just telling us to take a look at this. And I'm definitely taking a look at that. This is pretty scary things. And it's not a company that I can see myself buying right now. But who knows? Maybe the other sheets might give me something else. So here it's just telling us top to bottom line divergent. Again, this is the few times I really like this. These flags today are definitely working as they intended. It's telling me that the net income growth went down by almost 98%. So almost 99%. It actually went down 98.39%. Net income went down 98.39% this past year compared to previous year. If that doesn't scare you, I don't know what does. Excuse me. So now let's take a look at the chart machine. Here I'm just taking a look at some charts to see where this company has increased its expenses. We can see a huge increase in expense in both sales, general, and administrative. We've seen an increase from 150 to 192, and then another here from operating expenses from 336 to 391. We see not much, and interest expense also went up, but nothing outrageous in these expenses right now. Next, we'll take a look at the balance sheet. In the balance sheet here, we have total assets increasing at a nice healthy rate. We have total assets right now at 570 compared to last year at 555 million. But then when we look at this total liabilities, we're gonna see that our shareholder equity is negative. Liability has increased and is increasing at a fast pace. This year is at 867 million compared to last year of 654 million. Compared to the year before that of 494. So this company is collecting liabilities at a fast rate. And we can see most of that liabilities is due to total debt. So total debt right now is sitting at 621, and it's definitely over 75% of the liabilities. And we can see that huge increase has been increasing over the past 3 years. Receivables, this company's receivables is going up, so it's definitely collecting some money, and its payables is going down, so it doesn't owe that much money to customers, to its vendors. Cash and cash equivalents is sitting at a $20 million right now. Pretty, not surprised. I'm not gonna lie, I'm a little surprised with the value numbers of this company. I did not think they would be in the millions for some reason. I did think they would be a lot higher. But it's good to see in this perspective. This is actually seems to be a small company. I want to take a look at another pizzeria, to maybe Domino's next time, to see if they share the same number wise. But here back on track, we have cash and cash equivalents at about $19.5 million compared to last year's $22.3 million. So this company's cash and cash equivalents is definitely not big enough to pay anything right now. So now we'll take a look at red flags from the balance sheet, similar with what we just saw in the financials in the income statement. So here we can see that total liabilities have been overtaken total assets since 2017, and that's when we first got that negative shareholder equity. We can see that gap is now getting bigger and that negative shareholder equity is increasing, and that is definitely not a great sight to see. We can see here total liabilities are growing at a faster rate than assets. Assets have been growing in the single digits, while liabilities themselves have been growing in the 32 percentage, in the 30 percentage. When we're taking a look at asset distribution and liability distribution, we can see here 88% of the liabilities are based on non-current debt. The rest is just scattered around our usual. Here we can see asset distribution. A big portions is plants, property, and equipment. Maybe the real estate this company has, intangibles, but nothing here is really telling me, hey, this is definitely a great company to buy. We're having two red flags at the moment. The first red flag is average liability growth outweighs average asset growth. So here's just telling us what we saw before, that total liability growth is growing at a way faster rate than assets themselves. And we saw that with that negative shareholder equity. So the next flag we're getting is possible burnout time. And this is just telling us, hey, take a look at their cash flow and take a look at their operation cash flow, because net cash flow can be manipulated. It's a lot harder to manipulate operation cash flow. So take a look at operation cash flow and see the burnout time for this company. It's just telling us, hey, this company is not collecting money, so definitely take a look at how they're doing. All right, guys, so now we're going to take a look one more time at chart machines. Normally, I take a look at the cash flow statement sheet, but usually I only look at the cash flow there from operations. Here, I just want to take a look at some other aspects. We're taking a look at retained earnings, which is the dark green. This company is withholding some of its earnings, and I'm trying to read why. So this is the light green, sorry. And I'm going to take a look at their presentations for last quarter to see what happened and what's going on. But here we can see net cash flow from operations is decreasing, and that's definitely not a great thing to see. Current debt is pretty much on par, no big change, and net cash flow from financing is at a negative. Hopefully this company is paying off its debt. All right, guys, so just a quick recap of what we just saw. Papa John's, right? Revenue going down, cost of revenue going down. We see that earnings before income tax pretty neutral, and that net income almost at zero. If we take a look here, we saw that we have a few red flags that are definitely scaring me. The first one is book value per share current negative, and we noticed that we have a negative book value per share. Our shareholder equity right now, it's on the red, and that's definitely not a great thing to see. Finally, another thing we saw is net income itself went down by 98% this year compared to last quarter. So I was taking a read at their highlights, and I noticed that they're blaming a lot on a lot of rebranding based on a lot of the negative publicity they received this past year, which makes sense, but it does seem to be in the trend. I don't rate revenue itself. Net income rate, we can see net income, it's pretty flat. And if this is a one-time thing, we'll wait for next year. But right now, this is looking pretty scary in the income statement side. In the balance sheet, though, right, things seems to be a little different. This company has been increasing total liabilities dramatically for the past 2 to 3 years, right? And that's way before any bad publicity. So we can't blame this on bad publicity, this increase in liabilities and this small increase in assets. So we can definitely take those reasons out and just look at number wise. And the balance sheet is definitely not looking like a great place for me. We saw here too that we have a negative shareholder equity, like I mentioned before, right? And it's giving us almost a negative $10 book value ratio. we can see, right, that assets are growing at a slower pace than liabilities. When assets are growing in the low single digits, liabilities are growing at a huge 30 to 32%. Finally, our net cash flow from operations is decreasing as well, meaning this company is definitely not making as much money as it did before. And a final quick look at some of their highlights from their finance from their last quarter. They have lost sales. In North America, sales decreased 8.1% for the fourth quarter and 7.3% for the full year. International sales have decreased 1.6% for the quarter. So again, this is looking for me. I'm definitely going to have to pass on Papa John's. Not a company I would definitely invest anytime soon. Maybe we'll take a look at it next quarter and see how things are reacting. But now, while we're still here, I actually just want to take a look at the quarterly data in the income statement. See how if there was 1 year. Nope, it's just been a steady decrease. I just wanted to see if there was a huge outlier here, but no, it seems to be a quarterly average of just decreasing, so nothing there. So yeah, I definitely will pass on Papa John's. I am not being a customer for their pizza or for their stock anytime soon. I hope you guys enjoyed the episode. Like I mentioned, Lazy FA makes it so easy to look at all the information, which makes these episodes go pretty fast. I'm curious, would you buy or pass on Papa John's? Also, don't forget to subscribe to get updates on new videos. And check out my website, josenajarro.com. Have a good night, guys, and see you next time.